Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Inspire Medical SYSTMS Inc. quarterly report. Inspire Medical Systems, Inc. offers the following businesses and services. The company provides minimally invasive solutions for patients with obstructive sleep apnea, OSA, through its Inspire system, a neurostimulation technology that treats moderate to severe OSA. The key services include development of the Inspire system, commercialization of the Inspire system in the U.S., and internationally, a novel, closed-loop solution for monitoring breathing patterns and delivering mild hypoglossal nerve stimulation to maintain an open airway. The stock price crash of Inspire Medical Systems, Inc. Inspire Medical Systems, Inc. INSB, stock price has plummeted by a staggering 57.28% in the past year due to a series of negative events that have shaken investor confidence. The company's drastic reduction in financial outlook and operational challenges are primarily responsible for this decline. A major contributor was Inspire's lowered 2025 guidance, which saw its earnings forecast drop from $2.20 minus $3.30 per share to $0.40 minus $1.50 per share. This was accompanied by a revenue forecast decrease from $940 minus $955 million to $900 minus $910 million. The slower-than-expected launch of the Inspire V device and inventory issues also played a significant role. Furthermore, the company cited potential headwinds from GLP-1 weight loss drug trials, which led some patients to delay their therapy for obstructive sleep apnea, OSA. Analyst downgrades from prominent firms like J.P. Morgan and KeyBank further exacerbated the decline. Ongoing concerns about execution capabilities, upcoming competition in the medical device sector, and account capacity constraints also contributed to investor skepticism. As a result, Inspire Medical Systems stock has suffered significantly, with a 59.6% year-to-date decline and a 63.1% drop over the past 12 months. The primary drivers of revenue growth for the company are multifaceted. A significant contributor is the commercial availability of the Inspire system in various markets since 2021, including per-market approval from the FDA in 2014. This has led to increased sales in the United States and select countries in Europe and Asia-Pacific region. Additionally, factors such as increased market penetration, physician and patient awareness of the Inspire system, and sales outside the U.S. have also contributed to revenue growth. The launch of the Inspire V system, which generated $61.7 million in revenue, has further boosted sales. On the other hand, revenue decline is primarily driven by delayed adoption of the Inspire V system by patients and physicians, as well as destocking of existing Inspire IV inventory by customers. Other factors contributing to revenue decline include EU MDR approval delay, foreign currency exchange rates, lack of ENT surgeon capacity, and difficulty in maintaining growth rates as revenues increase to higher levels. Net income and profit margins. A shift in the market, the company's net income has experienced a decline, with a decrease of $8,565 for the 3 months ended September 30 and $9,053 for the 9 months ended September 30. This downward trend is attributed to two primary factors. Firstly, the delayed Inspire therapy has hindered revenue growth, leading to decreased sales. Secondly, customers have begun destocking their existing Inspire IV inventory, further exacerbating the decline in net income. In contrast, profit margins have shown a mixed performance. The gross margin increased by 1.7% for the 9 months ended September 30, indicating an improvement in operational efficiency. However, the exact percentage change in net income implies a higher profit margin, suggesting that the company's pricing strategy or cost-cutting measures are yielding positive results. The expenditure on corporate suites at sports and entertainment venues has also contributed to the decline in net income, with costs totaling $0.1 million in Q3 2025 and $0.3 million in YTD 2025. This suggests that the company is investing in non-core activities, which may not be directly contributing to revenue growth. Overall, the company's financial performance has been impacted by a combination of factors, including delayed product launches, inventory management issues, and non-core expenditures. To mitigate these challenges, the company must focus on optimizing its operations, improving product development timelines, and allocating resources more effectively. The company's financial performance indicates a positive trend in operating cash flow. For both 2024 and 2025, the company has generated significant amounts of operating cash, with $61,065 in 2024 and $64,507 in 2025. This demonstrates a consistent ability to produce cash from its core operations, suggesting that the business is financially stable and capable of meeting its obligations. The company's debt level has shown mixed results over the past year. According to page 4, the debt level increased by $22,568 from December 31, 2024 to September 30, 2025. However, page 19 reports a decrease in total debt from $81,130 on December 31, 2024 to $62,458 on September 30, 2025. This discrepancy highlights the need for clarification. In terms of interest expenses, there is a clear increase from $0 in 2024 to $15,000 in 2025, indicating a significant change. Additionally, page 43 notes a decrease in interest expenses by $1.9 million, 35%, compared to the previous year, suggesting some stability in this area. Overall, while there is conflicting information regarding debt level changes, it appears that interest expenses have increased significantly, but with some reduction in the latter part of the year. The financial performance of our company varied across different regions in the recent quarter. The United States was a standout performer, with revenue increasing by 9% and 12% for 3 months and 9 months ended September 30, 2025, respectively. In contrast, all other countries experienced a decline or modest growth in revenue. Specifically, revenue decreased by $2,744 in the third quarter, but only increased by $4,075 over 9 months, indicating relatively slow growth compared to the U.S. market. Management is cautiously optimistic about the company's outlook and strategy. In the short term, 2025-2026, revenue growth may be impacted by patients delaying Inspire therapy until a new version becomes available. However, direct-to-consumer marketing efforts will increase significantly to boost awareness and adoption. In the long term, significant capital expenditures are expected for manufacturing equipment, software development, and corporate office improvements. The company believes it has sufficient liquidity to meet cash needs for at least 12 months, but may seek additional funding through equity or debt financings due to potential global disruptions. Management's growth strategy focuses on developing innovative sleep apnea solutions, expanding coverage policies with payers, and increasing awareness through direct-to-consumer marketing initiatives. The financial strategy involves investing in property and equipment, which will increase depreciation and amortization expense. The company has made several key acquisitions and divestitures in recent times. Acquisitions include the purchase of manufacturing equipment and tooling for Inspire V, development of the SleepSync platform, computer hardware and software, strategic investments totaling $10.1 million, and property and equipment worth $32.1 million. On the other hand, the company has also made significant divestitures, including sales or maturities of investments valued at $252.8 million. Concerns about inventory buildup and supply chain disruption. Our financial summary highlights several concerns that may impact our business. Notably, there has been a significant increase in inventory levels, with finished goods inventory rising by $53,559 and overall inventory balances increasing by $61.7 million. This excess inventory poses risks of obsolescence costs, particularly for Inspire IV components valued at $2.1 million. Furthermore, customer behavior is also contributing to these concerns. Some customers are delaying the adoption of Inspire therapy until Inspire V becomes available, or while they trial other medications like GLP-1. Additionally, some customers have begun destocking their existing Inspire IV inventory, which could lead to further losses. The global supply chain and economic disruption also pose a risk of supply chain disruptions, which could exacerbate these issues. These concerns underscore the need for careful management of our inventory levels and supply chain to mitigate potential risks and ensure business continuity. That concludes the financial summary for Inspire Medical SYSTEMS Inc. Feel free to comment below, and I will be happy to answer them when possible.